you've watched the previous videos on this channel, you'll know that I approach property investing a little differently. In the first video, I shared how I bought my first property at the age of 26. In the second video, we talked about how many property deals fail. In the third video, I shared some of the lessons I learned early in my property journey. And in the last video, I explained a little more about the core framework, which is the structured method that we use in-house to analyse property investments before committing capital. Today, I want to show you how that framework works in practice, because frameworks are helpful in theory, but the real value comes when you apply them to an actual deal. So, in this video, we're going to run through a property opportunity through the core framework step by step and see what the analysis reveals. By the end, you'll see how the same deal can look very different depending on how thoroughly you evaluate it. Let's imagine a fairly typical property investment opportunity. This is a 3-bed terrace house in the Midlands. The purchase price is $220,000. The estimated renovation costs are $15,000. The projected rental income is £1,350 per month. At first glance, the numbers look fairly straightforward. An investor might quickly calculate the annual rent, compare it to the purchase price and decide the deal produces quite an attractive yield. And that's where many deal analysis stops. But instead of stopping there, we're going to run the deal through the core framework. Cashflow quality, operational control, risk management, and exit clarity. So, the first part of the analysis is cash flow quality. The question here is not simply how profitable the deal looks today, but how resilient the numbers are if conditions change. The projected rent is $1,350 per month. That produces an annual rental income of $16,200. But instead of stopping there, we need to consider realistic operating costs. So, maintenance, management, void periods, insurance, compliance, and of course, financing. If interest rates increase slightly or repairs are slightly higher than expected, does this deal still produce acceptable cash flow? In many cases, once realistic costs are included, the margins become much tighter than the original spreadsheet suggested. The question becomes whether the deal still performs well once the assumptions are stress tested. That's what determines cash flow quality. Next, we look at operational control. This property is a standard single-let house, which means the management complexity is going to be relatively low compared to something like a large HMO. There are fewer tenants, fewer compliance requirements, and generally fewer operational moving parts. That doesn't mean the property will run itself, however, but the operational demands are likely to be manageable for most investors. Operational control is really about understanding how complex the asset will be to run. A deal might look financially attractive, but still become stressful if the operational demands are far too high. So, in this case, the operational side of the investment is fairly straightforward. The third part of the analysis is risk management. This focuses primarily on financing and resilience. So, let's assume the investor is purchasing the property using a buy-to-let mortgage with a 75% loan-to-value. That means the investor is using leverage. Leverage can improve returns, but it also increases exposure to financing risk. If interest rates increase when the mortgage is refinanced, the monthly costs could rise significantly. So, the key question becomes whether the deal remains stable under less favourable conditions. What happens if interest rates increase by 1 or 2%? Does the cash flow remain acceptable? Or does the deal become financially uncomfortable? Stress testing these scenarios helps investors understand the true risk profile of the investment. The final part of the framework is exit clarity. This is where we ask a very simple question. If the investor wanted to sell the property in the future, who would realistically buy it? In this case, the property is a standard residential house in an established area. That means the potential buyer pool is broad. Owner-occupiers could buy it. Investors could buy it. which generally improves liquidity. But if the property were highly specialised, for example, a very large HMO or a niche development, the buyer pool might be much smaller. Understanding the exit helps investors avoid situations where they own an asset that becomes difficult to sell. After analysing the deal across the 4 core areas, we can summarise the strengths and weaknesses. Cash flow quality may be moderate depending on how conservative the assumptions are. Operational control is relatively strong because the property is easy to manage. Risk management depends financially on financial assumptions and interest rate resilience. Exit clarity is strong because the property appeals to a broad buyer market. Based on that analysis, the deal might fall into the category of proceed with caution or adjust the assumptions before moving forward. The key takeaway here is that the decision becomes much clearer once the deal is analysed across multiple dimensions rather than just one. One of the biggest mistakes I see investors make is rushing into deals because the headline numbers look attractive. But property investing is a long-term commitment, and small assumptions can have large consequences over time. Taking the time to analyse deals properly before committing capital can prevent many problems later. That's exactly why I developed the core framework. It provides a structured way to think through property opportunities rather than relying purely on instinct or optimistic projections. If you found this breakdown useful, feel free to subscribe to the channel because I'll be analysing more property scenarios like this in future videos. And if you're currently evaluating property opportunities and want a structured review before committing capital, you can apply for a core deal audit where I analyse and assess potential deals using this exact framework. Thank you so much for watching, and I'll see you in the next video.